Selling your home is supposed to be one of the great financial milestones in life. You build up all this equity, you sell, and you walk away with a huge and hopefully tax-free profit. It's the dream, right? Well, what if I told you that a simple decision you made years ago, one that seemed totally logical, could be setting you up for a nasty surprise tax bill? Yep, there's a hidden catch here, and millions of remote workers are walking straight into it without even knowing. See, this is the magic number everyone knows and loves. It comes from a part of the tax code called Section 121. And what it does is pretty amazing. It lets a married couple exclude up to $500,000 of profit when they sell their primary home. If you're single, it's $250,000. This is the cornerstone of building tax-free wealth in real estate. It's the number everyone focuses on. But here's the thing, it's not the whole story, not by a long shot.
And this is the question that changes absolutely everything. I mean, think about it. Since 2020, millions of us have set up shop at home. And of course, we claimed the home office deduction. Why wouldn't we? It seems like a smart, simple way to save a few bucks on our taxes each year. But that one little deduction, it can create a huge, unexpected tax liability down the road when you decide to sell.
What you might not realize is that when you start taking that home office deduction, you're basically inviting the IRS to become a kind of silent partner in your property. They're quiet for years, but the moment you sell, they show up to collect their share. And this is the critical part, their share comes from a pot of money that is completely separate from that big, beautiful $500,000 exclusion. All right, so let's give this surprise tax bill its official name. It's called Depreciation Recapture. It sounds complicated, but the idea is simple. When you claim a home office, a piece of that deduction comes from something called depreciation. It's basically a write-off for the wear and tear on the business part of your house. The IRS lets you have that tax break now, which is great, but make no mistake, they are going to claim that money back later.
Okay, the super technical IRS term for this is Unrecaptured Section 1250 gain. Now, don't let the jargon scare you. The only words that really matter are right there in the middle, or we're entitled to take. This is the IRS saying, hey, we're taking back every single penny of that tax break we gave you for your office. And the law specifically says this chunk of gain cannot, under any circumstances, be shielded by your normal home sale exclusion. It's a separate deal.
So here's the best way to think about it. The profit you make from selling your house gets split into two totally different buckets. The first bucket is your equity gain. This is the money you made just because your house went up in value. That profit is protected. It gets that sweet Section 121 exclusion. But the second bucket is the depreciation gain. This is every dollar of depreciation you ever claimed. That bucket is not protected. It gets hit with its own special tax rate, which can be as high as 25%. And this right here, this little bit of IRS guidance, reveals the biggest trap of all. You're probably thinking, okay, I see the problem. I'll just be clever and not claim the depreciation part of my home office deduction. Problem solved, right? Nope. Sorry, that doesn't work. The rule says you owe tax on the depreciation that was allowed or allowable. In plain English, that means even if you didn't claim it, the IRS says you could have claimed it, so you owe the tax anyway when you sell. With this method, there's just no way around it. So it sounds a little grim, doesn't it? But don't worry, you are not powerless here. You actually have a choice. The IRS gives you two different ways to calculate your home office deduction. And believe me, the path you choose can have a massive impact on your finances down the line. Let's break them down. Okay, on one side, you have the actual expense method. This is where you track every single penny, a portion of your utilities, your insurance, repairs, and of course that pesky depreciation. It usually gets you a bigger deduction each year, but it directly lowers your home's cost basis, and that's what triggers the recapture tax. On the other side, you've got the simplified method. It's just what it sounds like, a flat $5 per square foot of office space. The deduction is usually smaller, but look at that last line, no reduction to your basis, and that means no depreciation recapture. This right here is the golden ticket. It's the whole ball game. When you use the simplified method, the IRS literally considers the amount of depreciation you took to be zero. And if the depreciation is zero, there's nothing to lower your home's basis, which means there is nothing for the IRS to recapture when you sell. For every single year you use this method, you are completely dodging that recapture. Now, just when you think you've got this all figured out, the IRS throws in another wrinkle. It turns out that where your home office is on your property can totally change the tax math. And this is a nuance that catches a lot of people by surprise. So let's start with the good news. If your office is just a spare bedroom or maybe a corner of your living room, any space that's inside the four walls of your main house, the rules are pretty friendly.
You get to treat the sale as one single transaction. The entire profit is eligible for that big tax exclusion. You just have to pay the tax on the specific bit of depreciation you're recapturing. Simple enough. But, and this is a huge but, if your office is in a separate detached structure, like a converted garage, a little backyard studio, or a guest house, well, the rules get much, much harsher. In this case, the IRS forces you to treat the sale as two separate events, one sale for the house and one sale for the office. And the profit you make on that office portion, it gets absolutely zero benefit from the home sale exclusion. It is 100% taxable.
So you sell your house. How does the IRS actually track all this down and make sure you pay up? Well, it all comes down to one particular form. It's not one of your usual tax schedules. It's called Form 4797, and you can basically think of it as a heat-seeking missile designed to find and tax this exact type of gain.
And if we peek behind the curtain at the form itself, you can see how it works. First, you have to split up your home sale price and original cost between the personal part and the business part. But the real heart of this whole operation is line 22. I like to call it the recapture engine. This is the exact spot where you have to fess up and enter the total depreciation you were allowed or allowable to take over the years. From there, the form does the math, and boom, that taxable gain flows right onto your tax return.
Whew. Okay, I know that was a lot of pretty dense tax information, but here's why it matters. Understanding this stuff is what separates you from getting a surprise tax bill and making a really smart financial decision. So let's pull all these threads together into a clear game plan.
So what do you absolutely have to remember? First, that home office deduction isn't just a write-off. Think of it as a down payment on a future tax bill. Second, this tax isn't a normal capital gain. It gets its own rate, up to 25%. Third, you can't get out of it just by not claiming depreciation if you use the actual expense method. Fourth, the simplified method is basically your get-out-of-jail-free card. Fifth, a detached office can be a serious tax minefield. And finally, the key takeaway is that the choice you make on your tax return every single year has real long-term consequences.
And really, it all boils down to this one fundamental question for you and your business. What's more important? A bigger, more complex deduction today that comes with a guaranteed tax bill tomorrow? Or are you willing to take a smaller, simpler deduction now to make sure you have a clean, completely tax-free exit when it's time to sell? There's no single right answer for everyone, but now you can at least make an informed choice.